Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, P/E ratio, the most misused number in investing.
It really is, yeah.
You know, back during the height of the dot-com boom, it wasn't uncommon to see these high-flying tech darlings trading at a P/E ratio of over 1,000.
Oh, easily over 1,000. It was wild.
Right. Investors were completely convinced they were buying, like, the inevitable future. They were happily paying these astronomical premiums for companies that barely had revenues, let alone actual profits.
Which is always a dangerous game.
Exactly. And a short time later, the bubble bursts, and those same investors lost almost everything. Misinterpreting this one single metric is, it's easily one of the most expensive mistakes an investor can make.
Without a doubt.
So we are exploring financial metrics today, specifically the P/E, or price-to-earnings ratio. We want to unpack what it is, why it's critical, and why misinterpreting it is just, a massive trap. Okay, let's unpack this. Can we define the absolute basics before we dive into the complex stuff?
Yeah, absolutely. So the primary Investopedia definition, the fundamental math, is pretty straightforward. You just take a company's share price and you divide it by its earnings per share, or EPS.
Right, so share price divided by earnings per share.
Exactly. It's day one finance stuff. But the CFA Institute considers this a crucial tool for evaluating valuation, not just because it's a simple math problem, but because of what that number actually represents in the real world.
Right, it's the reality behind the number. Let me try to make this relatable for you, the listener. Let's ground this in the physical world.
Right.
Let's say you buy a local, a Main Street bakery.
Okay, a bakery. I like it.
Yeah. So you buy this bakery for $24 a share, and it generates $3 a year in profit for every share you own.
Right.
So 24 divided by 3 gives you 8. That P/E of 8 basically means it takes 8 years for that company to earn enough money to pay back your initial purchase price.
Assuming the earnings stay completely constant, yeah.
Right, assuming constant earnings. It's an 8-year payback period.
And what's fascinating here is that the P/E ratio is essentially a measure of time, but also a measure of expectations. Because like you said, you're assuming constant earnings.
Which almost never happens.
Right. Nobody buys a business hoping the profits just stay flat forever. A high P/E means investors expect massive future growth. They are willing to wait theoretically much longer for that payback because they expect the earnings to explode and shrink that time frame down.
So they're paying for the expectation of growth.
Exactly. Conversely, a low P/E means the company is either genuinely undervalued or, and this is the scary part, the market has incredibly low growth expectations. They think the business is in terminal decline.
Got it. So it's basically a gauge of market optimism or pessimism.
Yeah, and it is the ultimate tool for comparing companies within the exact same industry or sector. You know, comparing a hyper-growth software firm to a legacy steel manufacturer doesn't really work.
Right, totally different expectations.
Exactly. But if you compare two rival software companies, the P/E ratio tells you exactly which management team the market trusts more to deliver that future growth.
Okay, that makes sense. But since this entire metric is built on, measuring the time it takes to earn back your share price, a critical question naturally arises.
Which time frame are we looking at?
Yes. Are we calculating this using the money a company have already made or the money we think they will make? Because those are two very different things.
They are completely different things. And understanding that distinction is, it's the dividing line between amateur and intermediate analysis.
Okay, so break that down for us.
The market generally operates on two main versions of this metric. The first is the trailing P/E. That one uses historical earnings, what actually happened over the past 12 months.
So it's looking in the rearview mirror.
Exactly. It's concrete, it's audited, but it's backward looking. The second version is the forward P/E, and that uses projected earnings, what analysts expect to happen over the next 12 months.
Wait. If forward P/E relies entirely on projected earnings, doesn't that mean it's basically just a guess?
Well,
How can investors rely on a metric that hasn't happened yet? Analyst estimates are routinely wrong, right?
You're not wrong. Analyst estimates can miss surprise headwinds. They can underestimate product cycles. There is definitely uncertainty there.
It feels like a big leap of faith to deploy hard capital based on a guess.
It does, but you have to remember how capital markets actually function. Financial markets are forward discounting mechanisms. Institutional investors aren't pricing a stock based on what it did last year.
They're bracing it on the future.
Right. They're pricing it based on the cash flows they expect next year and the year after. So while there is uncertainty, there are multiple ways to run the numbers to protect yourself.
Okay, so how do we double-check those numbers?
Well, there's an alternative formula. Instead of using per-share data, you can take the company's total market capitalization, the total value of all shares, and divide it by the company's total net income.
Right, I actually saw this when I was looking at Wikipedia's breakdown of the math.
Oh, really?
Yeah, and it pointed out a really crucial nuance. Mathematically, market cap divided by net income usually gives you the exact same answer as share price divided by EPS.
Usually,
Y-
yes.
But Wikipedia notes that it can be entirely inaccurate if the company has recently issued new capital, like if they printed new shares.
Yes, that is a classic trap. It's an accounting illusion based on timing. Market cap is a real-time snapshot of today's share count. But net income is a backward-looking 12-month accumulation.
Right, because earnings per share is often reported using a weighted average of shares over the whole year, not just today's exact count.
Exactly. So if they issue a bunch of new shares today, the market cap updates instantly, but the EPS might lag behind. It's a huge warning light.
Here's where it gets really interesting, though. Let's look at how this works in real time. Let's walk the listener through a concrete example to solidify this.
Okay, let's do it.
Say you're watching a stock. The share price is $50, and they have an EPS of $5. 50 divided by 5 gives you a PE of 10, right? 10 years to pay back.
Yep, a clean multiple of 10.
But let's say the company suddenly gets way more efficient and that EPS jumps up to $7. But the stock price stays at 50 for a bit. 50 divided by 7 means the PE drops down to roughly 7.14.
Right, the multiple compresses.
Exactly.
Yeah.
And that indicates the company's valuation has technically decreased, representing a potential bargain for the investor. You're getting more earnings for the same price.
And that compression is the holy grail for value investors. But it's also highly tempting for an investor to see that dropping PE and assume it's an automatic steal.
Oh, for sure.
Or, on the flip side, they see a high PE and immediately assume it's a ripoff. And that black and white thinking is arguably the biggest trap in investing.
Because it's never just black and white.
Never. The finance academic Jeremy Siegel has some great insights on this. He points out that a high PE ratio doesn't automatically mean a stock is overvalued.
Really?
Yeah.
Even if it's, like, sky high. Even then, a high PE is perfectly sustainable if the company has massive, durable growth expectations, or if the broader market expects high returns from that specific sector. So you're paying a premium for quality. It's kind of like, it's like buying concert tickets.
Okay, how so?
If you want to sit in the absolute front row, right against the stage, you're going to pay a premium price. You're paying a high PE. But if you sit way back in the nosebleeds, you pay a heavy discount, a low PE.
That's a great way to look at it.
Right. Paying a premium price for the front row doesn't mean you're getting ripped off. You're just buying a premium experience, or in this case, a premium growth engine.
Exactly. You are paying for securing dominance tomorrow. And if we connect this to the bigger picture, you also have to realize that this ratio doesn't exist in a vacuum.
What do you mean by that?
It is heavily warped by outside economic conditions, specifically changes in interest rates and inflation. Macroeconomic influences change everything.
So the broader economy shifts what a good PE even is.
Precisely. Historically, the average PE ratio for the S&P 500 index ranges between 10 to 20. But that average constantly shifts depending on those macroeconomic tides.
Because if interest rates are high, you can get a guaranteed return from bonds.
Yes. The opportunity cost changes. If a completely risk-free government bond pays you 5%, you aren't going to take a huge risk in the stock market unless it offers a much higher potential return.
And the only way the stock market offers a higher return is if the valuations drop.
Exactly. Multiples contract. A PE of 25 might be totally normal when interest rates are at 0. But if rates jump to 5%, that exact same company might suddenly only command a PE of 15.
Wow, so the company didn't even change, just the environment around it.
Exactly. And inflation does the same thing. If you were waiting 10 years for a payback, high inflation means the money you get in year 8 or 9 is worth way less.
Right, it erodes the purchasing power. Which just goes to show relying entirely on the PE ratio on its own is like, it's like driving with one eye closed.
Yeah, it really is. It's incredibly sensitive to both internal projections and external macro factors.
So what does this all mean? How does the listener actually apply this in a practical way without falling into those traps?
It means you have to use a broader toolkit. The PE ratio is not a perfect standalone measure of valuation. To be an informed investor, you must use it in conjunction with other metrics.
What kind of metrics should they be pairing it with?
Specifically, I always look at the price-to-book ratio and the dividend yield.
Okay, so price to book looks at the actual assets, right?
Right. It looks at the balance sheet. It grounds the expectations in reality. If the PE is high, but the price to book shows they own incredibly valuable physical assets or intellectual property, it validates the premium.
And the dividend yield cuts through all the accounting tricks.
Exactly. It tells you how much hard cash the company is physically returning to your account.
Got it. Okay, let's do a rapid-fire summary of the key takeaways for you, the listeners, so we lock this in.
Sounds good. First, the PE evaluates valuation, measuring the time and market expectations priced into a stock.
Second, high or low ratios aren't inherently good or bad. They signal growth expectations versus potential undervaluation.
Third, always know if you're looking at a backward trailing PE or a forward projected PE. The variance matter.
And finally, it absolutely must be used as part of a balanced analytical diet, alongside things like price to book and dividend yield.
Spot on. But I want to leave you with one final lingering question to ponder as you look at your own portfolios.
Ooh, all right, what is it?
We know that forward PE relies on future estimates, right? And we know macro factors like inflation can wildly shift the historical S&P 500 average completely out of that 10 to 20 range.
Right.
So you have to ask yourself, next time you spot a stock with an incredibly low PE, have you found a hidden gem? Or just a dying company with zero growth left in the tank?
That's all for this weekend's deep dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.